I'd just be interested on other members of the panel if you've been involved in a development finance of late, because that's a small percentage of the overall lending book these days. It's also quite a difficult sector, so I just wonder what your recent experiences are.
Yes, we have. I mean, I guess it's more like a repositioning. It's like we financed in Rome, so it's development and Rome, which are
good risk,
good combo, and 80% LTV. So that's
okay.
But yeah, no, we did finance a developer to convert an office building, former bank headquarter, into what's going to be an Edition hotel by Marriott in next to the U.S. Embassy in Rome. So very strong location, very good operator who owns a collection of very good assets, but very high and steep, LTV and risk. I mean, I guess basically we underwrote this deal, so we put 60 million in it, but we underwrote it as if it was an equity deal, frankly, for us. So, we believe in the operator, the location, and I guess the business plan. But it's not, it's not anyone's cup of tea. And also, we had to go through the hurdle of investing in Italy for a non-Italian investor is tricky.
Is it open now? Is it finished?
No, it's halfway there. So it should open Q1 next year.
What about cost overruns and monitoring? Is that working out?
Yeah. No, that's a topic. I think with Italy, it's not really cost overrun. It's basically the time and the pace at which they work. So it's pretty much when they want.
So it's not just the language; it's we've covered lots of different landscapes.
No. So I think it goes also to Tim's point, which is I think on the lending side, and I guess quite curious in the audience, there's also developers and investors who look for finance, but you have pretty much in each market a core club, I'd say, of senior lender, like 2, 3, who knows the market, but they know what they can do also. They have a pretty, strict parameters of LTV, debt to EBITDA, development or not. But then what you see now with this wave of capital is you have a whole host of alternative lenders, which I guess we would fall into to some extent, which are willing to take some risk and which are willing to go in higher risky situations, but obviously they cost more. So it's not like a 2%, it's going to be high single digit or sometimes low double digit. So as an operator it may be good because then you put little equity, but you have to understand with whom you're dealing, because these people are kind of, as I said, we underwrote it as an equity deal. So if it goes bad, we're happy to do what it takes to recoup our investment through. It doesn't mean being aggressive, but it means that that's the way we underwrite things. And then.
So, Carine, when presenting a business plan, do you think the banks are more generous on loan to value, debt service covenants? What sort of structures do you think it's improved from a lender's perspective or from a borrower's perspective? How do you see the current mood music?
I mean, for the moment they're quite keen. There's a lot of development happening in the UK and Europe. They're keen to, a lot of the bank, as you say, there is a club and people are keen to do the financing of the development. I think from what we're asking, however, they're becoming a bit more analytical in the way they look at things. We have more requests for monthly forecasts, for instance, as opposed as before, like really yearly 3-year plan. But now they want a lot more certainty. They want a lot more sensitivity analysis being done, so they can really make sure that when they provide their terms, they have more security. So I'm quite impressed actually with the level of DD they're doing. So you can feel they've learned from the mistakes in the past.
Oh, you're nodding vigorously, so
I know,
actually,
for us, it's we're doing leases, so the limit, I guess, the information that they're requesting is quite limited. But I heard that they're looking to do a lot more. They're looking for more information, but for us, it's more relationship based. It's very local, and we've been buying quite a lot in Germany, and then we have a very good relationship with German banks. And then I can actually quote the terms. They're very happy with it. It's about mid-hundred-ish as a single asset. The margin is 70 basis points, and it's 10-year. And it's based on 10-year swap. But then also the arrangement fee is only like 10 basis points. So we're
don't get carried away. This is not the UK.
And it's 40% LTV, so it's very low leverage. So all that combined. So I know that having a relationship, and in the local market you can actually arrange a good deal.
So to the point earlier, what is it you're funding? Is it a lease? Have you got equivalent of
Yeah.
freehold or?
It's a freehold, but it's an operating lease. So we have an operating party who's giving us the lease.
Okay.
I think going back to the development, I think it's either my view is either a big boys game, like institutions who have the capital and don't really rely much on financing, or then you have to go with alternative financing providers. And to tie into Carine's point, I think then the role of advisors is pretty key, because you underwrite it based on forecast and operations, and you have to rely on strong advisors to do that. So.
And that's why it's got a high